Hi everyone, good morning. Uh, so today we are going to learn about a very important idea in corporate finance called weighted average cost of capital or simply WACC. WACC represents a company's overall cost of getting the money from the investors, both the people who lend the money and the people who actually buy the ownership of the company. So the weighted average cost of capital is actually a relationship between the investors of the company, the investors, and the lenders. And understanding weighted average cost of capital is actually a very important topic. I mean, it's a very important thing. Why it's very important? Because if you are in your early career and you want to be a finance professional, or someday you see that you will be starting your own company. So the elements of the finance, so weighted average cost of capital is actually a very important element of finance. If you go over the internet and uh, try to search the curriculums of CFO programs or any professional program, so I actually have a snippet for you guys just for reference. So if you go over the internet, and I have also achieved it from the internet, this is actually a CFO program which is being held by a very prestigious institution in Delhi itself. And if you look at the curriculum, there is cost. They will be talking about cost of capital, capital budgeting, valuation, merger and acquisition, financial modeling, and IPOs and credit rating. So that's actually a building element of the program for a CFO or a financial professional. Uh, so that's why understanding the concept of cost of capital is very important. So let's get back to the topic. So it's a relationship between the investors. So investors are actually the lenders of the money. Uh, and the investors who are the lenders of the money and okay, just to stretch it up. So it's a relationship between the investors and the shareholders. My bad. So the investors are the lenders, and the shareholders are actually the owners of the company. So weighted average cost of capital, it means that what the minimum return must a company earn to keep its investors satisfied, basically. And uh, here you can see the pictorial diagram which I have taken from the internet. So weighted average cost is divided into two parts, equity and debt. This is the cost structure of the company. So, okay, we will talk about this in a moment. Let's first discuss about the introductory part of this weighted average cost. So, if the company earns less than what is required, the required rate of return, so investors might not be willing to support it. And because of it, weighted average cost of capital actually becomes a benchmark in financial decision making and valuation, and along with other corporate performance analysis. The weighted average cost of capital uh, is actually the minimum return that a company must earn to keep its investors satisfied. Here also, introduction to the weighted average cost of capital, it's written that the overall cost of financing from all the capital providers is represented by WACC. It combines the cost of debt, cost of equity, and sometimes the preferred stocks weighted by their prospective proportions in the company's capital structure. The company's capital structure, if a company has raised, so this is representing the ownership structure, the capital structure, sorry. So I'm assuming that the company has actually 40%, or let's assume 40% debt. This is representing debt, And this much is representing the preferred equity, which I'm assuming is to be 5% maybe. And the rest of the portion, I'm assuming it's at equity. So equity means somebody buy equity. So if you are running a company, you are not investing your money. So you are not investing your own money. So how do you, why and how and why do you expect the other people to invest money along with you? So this actually represents the ownership share. Debt is actually by the lenders. And we have discussed previously also that preferred equity also act as a debt only. So the features of preferred equity are also somewhat similar to debt. Even though technically it would be wrong to say that preferred equity is debt, but it has features which actually makes it pretty much work like debt. So why does weighted average cost of capital matters? So it's important for several reasons. It's a benchmark for investment decisions. Companies only want to invest in projects that create value. And to check this, they compare the project's expected return with weighted average cost of capital. If the expected return is greater than the weighted average cost of capital, then the project creates value. This means that I am assuming that after everything, I should be generating at least 12% of returns. But if my return, if after investing in the project, or if I have an opportunity to invest in some project, and that project is generating me 15% returns, 15% of returns, so I will say that this project is actually creating value. So I am getting a spread of 3%. So spread basically in finance means the difference. So this is just a technical or a fancy term, fancy name for difference. So just don't get confused with all these terminologies. So uh, if expected return is greater than weighted average cost of capital, the project creates value. And if the expected return is less than the weighted average cost of capital, the project is not getting any value, or we can say that it destroys value, destroys your time, your money, your efforts. So this is so these kind of projects, so you as a financial professional try to avoid. Um, okay, so let's talk about discount rate in valuations. So weighted average cost of capital actually works as a plugin for discount rate in DCF valuation. So it's commonly used in discount as a discount rate for future cash flows to estimate the enterprise value, equity value, and the intrinsic share price. It also acts as an indicator of the firm's risk. So higher financing cost means that the firm is risky. Higher business or financial risk, lower ability to invest cheaply. Okay, let's discuss about point number one here. So higher financing cost means, I will just rub it, I will just remove everything here first. That's okay. Higher financing cost means that let's assume that you are running a company. So you have raised $10 million first in the first round. You have again raised $15 million. And I'm assuming that initially you raised it at a price of I'm not talking about startups. I'm talking about a company which is a healthy company. This scenario here, I'm talking about a healthy company. So you have raised $10 million of debt, maybe for some reasons. Uh, then you have okay. Then you have raised $15 million after a few years. So Initially, you have raised it at 7% rate of return, 7.7% interest rate. The next round, when you will be raising debt, because you already have debt and you were not able to make the company efficient using this much money, and you raise another round of money, another round of debt. So this round is not going to be cheap for you, based on your history, based on your history of debt and your financials. This money is going to cost you more. So this is going to be maybe not 7%, not less than 7%, but above 7%. So this is going to be more than 7%, and I'm assuming a figure 9%. And this is a hypothetical example. So this is actually what this first point means: higher financing costs, because the more you money raise, so in future your financial debt is going to, or your cost of raising the debt is going to increase upwards, not downwards. So higher weighted average cost of capital also means that it's actually an indicator of risk in the firm also. So higher average cost of capital indicates these 3 pointers. Higher financing cost, because the cost of uh, weighted average cost. Okay, we will talk about the formula in a while. So weighted average cost of capital actually calculates actually represents the firm's overall cost of financing, both uh, from all the capital providers, basically, from overall cost of financing from all the capital providers. So the more I mean, with the increasing interest rates, the risk also increases, because this spread then decreases, and you need to create value creation. You need to generate more return than your average cost of capital. I hope this much was clear. For somebody who is actually not from financial background, I have tried to make it in such a simpler way that everyone can understand this topic. So, okay. And another point here is that the low weighted average cost of capital suggests the opposite, that the risk is low. So this is um, the risk cost is actually tied up to the cost is actually cost of raising the money is actually proportional to risk here. Higher the cost, higher the risk. Lower the cost, lower the risk. Okay, and it also works as a tool for performance assessment. Managers compare the company's actual return to its weighted average cost of capital to see whether the company is creating or destroying value. Destroying is the wrong. I mean, calling it destroying is very strong word. I would not say destroying, but it's not creating any value, because if you have evaluated the company's expected return is less than weighted average cost of capital, then you will not invest in that company, because you know that your time, your money, your efforts are not going to pay off. So, so you will avoid these kind of projects. So let's talk about now the weighted average formula. Sorry, the weighted average cost of capital formula. Okay, so this is actually an important formula. This is actually an important concept in finance. So I want you to understand this clearly. And if you encounter any doubts after the session or after watching this video, you can always comment in the comment section of the video. I have kept it open. So weighted average cost of capital, like we have discussed in the initial part, overall cost of financing from all capital providers. They could be debt holders, they could be equity holders, they could be preferred equity holders, and many more. So basically, here we have only talked about, in this formula, we have only considered the debt and the equity portion. So RE represents the rate or the cost of equity, and RD represents the cost of debt, and R represents actually the rate. Okay, what does this means? Here I actually did this thing. Okay, so try to understand this in a easier way. Out of total debt, out of total ownership, how much is equity? Let's assume it's 40%. And how much is debt? Let's assume it's 60%, or either way around. Let's assume that this is equity portion, this portion is representing equity, and this portion is representing debt. Because if it was either way around, so more debt means more risky company. So I have, for the initial phase, I have assumed a scenario where equity is more in the company and debt is less in the company. Then less than equity. This is also an indicator if whether a debt is more or the equity is more. If debt is more in the company, then we will be looking at whether it's a leverage buyout, LBO, or is that a distressed company, or then we actually have to go into the detail, the capital structure. Then we actually have to study the capital structure of the company first. And this is actually influenced by the debt ownership is actually influenced by convertible stocks, convertible bonds, convertible securities majorly, complex and simple. So this is actually an example of simple capital structure, and a complex capital structure involve convertible securities. So even though it's not related here in weighted average cost of capital, we will be not talking about this topic in detail. I have just shared so that when we discuss about it, you are able to connect the dots. Okay, so this portion is representing the part of equity, and this portion is actually representing the part of debt and the part of equity. So basically, what it means is I'm assuming that the company has 40% debt and 60% equity. Um, 40% is debt and 60% is equity. And let's assume the rate of debt is overall rate of debt is 12% and overall rate of equity because of high risk is 15%. The rate of debt, the rate of equity, the cost of debt or cost of equity. One more thing which comes along with debt is the tax shield. So when you take debt, so government has policies where there is a tax shield. It comes along with debt, raising debt. So you get a tax benefit also. So that's why always remember to subtract the tax rate out of it. So let's assume that corporate tax is 25% and your cost of debt is 12% into 40%. Simply you are going to consider the 75% of this much. This is what does this means. So the tax shield, the, this 25% goes to the government, and this actually works as a tax shield for you guys, for a professional, financial professional, or a corporation. So this is actually helpful, and that's why we called it a tax shield. Okay. So E represents the total value of equity, D represents the market value of debt, V actually represents the total capital, which is E plus D, and I prefer writing E plus D rather than V. So the formula is E by V, and because this is out of total value, it's representing the percentage of equity. We multiply it with the cost of equity. Then D divided by V is representing the percentage of debt in the capital structure, and we multiply it with cost of debt, average cost of debt, and we multiply it along with the tax shield, which is 1 minus the tax tax rate, corporate tax rate. I hope this much was clear. So let's move to the next. Uh, let's discuss it further. So when we understand, let's understand each component individually first. So the market value of equity is represented by E here. So equity value is determined using the current market price of the share and it's multiplied by the number of outstanding shares. So how will you get this number, the percentage of equity in the company? So basically, you will be looking at the market value of the equity, which is calculated using share price, and you multiply it with the number of shares. So it reflects how much the stock, the stock market thinks the company is worth. The market value of equity, this is how it's calculated. When we talk about the market value of debt, so market value of debt includes the corporate bonds, bank loans, notes payable. So debt should be valued at its market value, not at book value. So just remember this thing, not at book value. So companies, when they release their financials in the debt portion, there is one book value and there is the market value also. So that's why we actually have to consider the market value, not the book value of debt, not the book value. Just remember this thing. Cost of equity. Well, let's talk about the cost of equity now. So, uh, this is actually the return the shareholders expect. And most commonly, cost of equity is represented by the capital asset pricing model. Mostly. So that's why we discussed about capital asset pricing model previously. So capital asset pricing model, it's risk-free rate. We multiply the expected return from the market premium, and we multiply it with the beta. How the beta is actually the relationship of the stock with the market. So risk-free rate is the return from the government securities, and this is nearly risk-free. That's why it's called risk-free rate. Government securities, the government is going to pay you. If government doesn't have the money, what can the government do and how it will pay? So government can always print money. And this has actually happened in during the COVID. So in the recent times, this actually happened in the COVID in the United States. If you follow news, there was quantitative easing where the government actually pumped in the money. And now, when you look at the United States in the recent times, so quantitative easing also have negative effects. And now the US is actually suffering from the negative effects of the quantitative easing. Uh, we will discuss about these later on, how and why. Okay, so risk-free rate. Beta measures the sensitivity of the company's stock compared to the overall market. Beta is higher than 1, this means highly volatile. And if beta is less than 1, it's more stable. So beta 1 means it will move in the direction of the market. It could move in the direction of market, and beta less than 1 means it's not related to the market. So when the beta is greater than 1, it doesn't mean always that it will go upside or downside, only positive only. So it can go either ways. It's that much sensitive. If the market is moving like this and the beta is 2 or beta is 1, so the stock can go in the same direction or in the opposite direction also. So it's not that it will only go above or in the same direction as the market is going. But beta less than 1 means it's more stable and doesn't get influenced by how the market is moving. So in this case, they are actually talking about uh, defensive and the other kind of security is, which I'm not able to recall right now, the other kind of growth stocks, defensive and growth stocks. We will discuss about these we have actually discussed about these in the sector expert series. So, so this is what the growth stocks are actually highly sensitive to the market, and the defensive stocks are less sensitive to the market. Defense growth stocks means, let's assume tech companies, and defensive stocks means like groceries, FMs, groceries majorly. So whatsoever, healthcare. If there is a boom in the economy, people doesn't start to fall sick. So these kind of stocks keeps on. These are defensive stocks, so they are more stable, but the growth is less, and risk is actually associated with return also. If the risk is high, the return is also high. Expected return is high. You cannot forecast that the risk is going to, if the risk is high, this is not a valid statement, but yes, it's associated with the risk is associated with the return. The more risk, the more return is expected. And when we're talking about defensive stock, just to give you a little glimpse, whatsoever is the market condition, people are going to eat food, people are going to travel. So this is actually the element which divides defensive and the growth stocks. And always understand, try to understand about beta using these ideologies or these concepts. So you will be able to retain these concepts when you will connect these concepts with the real market scenarios. Okay, so we have discussed about the CAPM previously also, and right now we have just did a quick summary. The cost of debt. The cost of debt is actually the effective rate that the company pays for borrowing funds, and it can be estimated from interest rate on the existing loan, yield to maturity of the bonds, current borrowing rates. So when the debt is cheaper when equity because of equities, and sorry, so debt is actually cheaper than equity in most of the cases because companies receive a tax benefit from interest expense, and after this adjustment, RD rate of debt, we multiply with the tax shield. This is always going to be, so we are only, let's assume that 25% is the tax rate. So we are only going to consider the 75% of the overall calculation, which is related to the debt. So this is what it means. So in the previous example, when we talked about 40% is debt, and the rate of debt, if I still have, yes, 12%. The rate of debt is 12%. This is going to be, okay, whatsoever it's going to be, we are only going to consider 75% of this whole scenario, this whole calculation, because 25% is the tax shield because of the government. And that's why because we are only considering the 75% of the total debt, the total cost of debt. Where's this? Equity will be more costlier and the debt will be more cheaper than equity. Okay, I hope this was clear. So capital structure, let's the capital structure component. The capital structure is actually this reflects how much equity versus debt the company use. So if the company has an equity of 70 million and a debt of 30 million, so total capital will be 100 million and 70 divided by 100 and 30 divided by 100. This is going to give you 70% equity and this is going to give you 30% of debt. So this is the total capital structure of the company. This is representing. So equity upon total value and debt upon total value is going to be 30% and 70%. This is pretty much evident in itself. And the role of tax. Since we have discussed about the role of tax, let's discuss it one more time. So tax affects only debt, not the equity. And since interest is actually tax deductible, debt becomes cheap. And that's why the formula multiplies the rate of debt with 1 minus tax rate. And this T is actually rate, not an actual value. And here we actually have an extended formula of weighted average cost of capital. Here we have considered that if the company has a preferred share, uh, preferred stocks in their capital structure, so then the formula, there's nothing else. Preferred stock doesn't, yes, preferred stock does behave like debt, but they do not get a debt shield. So uh, the tax shield is only with the debt. This is a simple formula. You have just added preferred stock in the capital structure. But one thing you need to remember here is capital preferred stock is actually not in the capital structure of the company. They do not really add it. And I think I have made a little printing mistake here. Let me just quickly fix it. Okay. Uh, so the weighted average cost of capital, the WACC formula, after you get preferred stock in the company's capital structure, the formula becomes uh, equity into equity plus debt into cost of equity, R of E, debt, the percentage of debt, the percentage of equity in the company capital structure, equity plus debt, and the cost of debt into 1 minus tax rate. But when it comes to preferred stock, you need to understand this thing. When it comes to preferred stock, because preferred stocks are usually not shown in the company's capital structure, you need to add the preferred stock portion in the calculation of the preferred stock portion. So preferred stocks, so you add the preferred stock portion here. E plus D equity plus debt plus preferred stock. And then you can multiply the cost of preferred stock. So this much, just remember this thing. And this is specifically for the preferred stock only, not for the whole capital structure, equity. So in the denominator, just be cautious about this thing. And I have fixed it here also. So Okay, this was important, and this actually I actually made a printing mistake here. Okay, so let's move to the practical example of a back calculation, and the best way to test your concept is to practice it or to apply it. So let's talk about practical example of that. Suppose a company has a market value of equity 120 millions, market value of debt is 80 millions. Cost of equity is 12, cost of debt is 5, and the tax rate is 25%. So how do we have calculated, how we have done the calculations? So understand this thing with the formula. If you the for simple formula, so market cap of equities, we need to understand first the weights. So it's about equity. Let's talk about equity. So equity is going to be 120 and divided by 200, which is 120 and 200, 80. Debt is going to be 80 divided by 200 again. So this is going to give us the equity percentage in the company is 60% and the debt percentage in the company is 40%. Now we have the cost of equity, which is 12%. The cost of equity is 12%, and the cost of debt is 5%. Because the debt actually has a tax shield also, the tax rate is 25%. We are going to multiply it with 1 minus 25%. The overall calculation is going to give us 8.7%. What you need to do is just to plug in, you just need to plug in the numbers and don't make mistakes because here you are multiplying percentage with percentage. So you just consider this thing while calculating. You are multiplying percentages with percentages. All right. So uses of weighted average cost of capital in business and finance. So capital weighted average cost of capital is used in capital budgeting. So this is as a hurdle rate for evaluating potential investments because projects must exceed weighted average cost of capital to be accepted. It also is used in business valuation. In DCF valuation, free cash flow are discounted using weighted average cost of capital. Also, optimal capital structure, companies try to find the best mix of debt and equity to minimize weighted average cost of capital during acquisition and mergers also, and performance metric also. This is a performance metric also. So economic value EVA is NOPAT minus weighted average cost of capital into capital invested. And if EVA, economic value added, is less than zero, the company is generating premium returns. Okay, so let's do one thing. Let's wrap this session here only, and we will talk about uh, the weighted average cost of capital in next session. Thank you for attending the session. My name is Deepak Best, and I will see you in the next session.